Why the stock market won't be allowed to crash. Imagine a stock market decline that the US government can't afford to let happen. Today, we're diving into a shocking economic secret. The stock market is not just a playground for investors, it's the lifeline propping up federal tax revenue. Did you know that capital gains, fueled by the top 1% who own half of US equities, are driving a record tax haul? Yet, while wages crawl at a snail's pace, financial assets are skyrocketing past GDP. Why? Because the government is incentivized to pump the market, widen wealth inequality, and plug a massive fiscal hole with gains from financial assets. In this video, we'll expose how the system really works, why stock market decline is off the table, and what it all means. This is a 6-month chart where each candlestick represents 6 months of time, and this is the S&P 500 going back to 1957. As we can see, there's a regular chart. Here will be a logarithmic chart, so this adjusts for exponentials. But the stock market in general, whether you look at it in regular form, where it's a parabola, or in logarithmic form, which arguably this chart is even more impressive, the stock market goes up and to the right almost relentlessly. So why is this? Here is the S&P 500 divided by M2 money supply and S&P 500 divided by gold. And remember, with a relative chart, if the numerator is increasing faster than the denominator, the line goes up. And this makes sense. The S&P 500 during the dot-com bubble, stocks were doing very, very well. They were growing. The S&P 500 was growing faster than both gold, the price of gold, as well as the supply in the M2 money supply, the supply of dollars in the M2 money supply. So both of these lines went up. But the point here, let's look at gold first. So if you bought basically any time in the past 4, 5, 6 years, if you bought the S&P 500, in real terms, you are down. You have actually lost money, and you would have been better suited just buying gold. Put another way, remember the other way to look at this is you can invert it, and this is gold relative to the S&P 500. Now, as we can see, here's where that is currently trading at. Now, unless you were investing in this section here or this section here back in the 70s and 80s, gold has outperformed the S&P 500. So put another way, if you have bought stocks, you have underperformed monetary debasement. Again, gold is not useful tracking monetary debasement or the expansion of the money supply on a day-to-day, week-to-week, month-to-month, or even year-to-year basis. But over many years, certainly over decades and centuries, gold is a fantastic way to track monetary debasement. In white, I think this chart is interesting because what it shows is that recently, in the past 2 or 3 years, the S&P 500 versus M2 has ripped higher. Now, I started to talk about this in 23, 24, that, a lot of what we were seeing in the stock market, whether you're talking about the NASDAQ or the S&P, over the past, call it 3 years of a pretty good bull market in stocks, has been investors gaining realization over the fiscal reality of the US. These investors are quite smart. They know what the Lebanese stock market looks like. They know what the Argentinian stock market looks like. They know that stocks, to some degree, are a hedge against monetary debasement. And I started saying, look, like a good part of the run-up that we've seen, we had 2 back-to-back years of like 20% returns in the S&P 500, just crazy, crazy returns. I said that a good amount of that was investors pricing in, trying to hedge risk of currency debasement. It was kind of mocked at the time, but what's interesting is over the past year, you have very kind of traditional, respected, reputable people in the macro space, in markets, talking about just that, which is stocks are a way to protect yourself against monetary debasement. And so, to some degree, what this chart is trying to show is that stocks are seen by especially older investors as a way to protect your purchasing power, to protect your wealth. On average, the S&P 500 appreciates about 8% per year. On average, the M2 money supply post 2008 grows at about 8% per year. So in real terms, you are flat. Now, the M2 money supply has just barely broken out to a new all-time high, but as we can see, SPX versus M2 has broken out, going back to 23. Well, again, markets are forward-looking instruments. The M2 money supply is not a market. It is not a forward-looking instrument. So something like the S&P 500 is. And so if investors are starting to price in future currency debasement, S&P 500 will appreciate before the M2 money supply, and you'll get something looking like this. Again, this used to be kind of a strange theory, but now even reputable, respected market participants are saying as much, which is stocks are just a way to protect purchasing power. Here is total debt divided by total tax receipts, total debt divided by GDP. 2 points here. Number one, GDP and tax receipts basically track each other. You can think of them as roughly equivalent in terms of the rate of change and the direction that they go. But the point here is that total debt has been outpacing both revenue, right, tax receipts, and GDP, which is total aggregate US economic output. Debt has been outpacing them since going back to the early 80s. The other way to think about it is here we will invert this and look at GDP divided by total government debt. We're just flipping this. What we can see is we've been getting a negative return on each dollar of debt has been getting us less and less and less and less actual economic output. So that is called a declining marginal productivity of each dollar of debt. Here is part of the reason. So we have been running this utterly insane fiscal deficit. We've talked about this at length, but just as a reminder, generally the deficit tracks the business cycle. When the country goes into a recession, as noted by a high unemployment rate, the government runs a high fiscal deficit to stimulate out of that recession. Well, what we've seen since 2008 is that actually the deficit has gone from 1% of GDP to it's actually 7%. So the deficit has gotten 7 times worse, but yet the economy, as measured by the unemployment rate, is actually better off. Now, of course, there's caveats there, major caveats. I've done many other videos on those caveats, but just going off the headline unemployment rate, our deficit is 7 times as bad as it was going into '08, and yet the unemployment rate is actually lower. So here's the S&P 500. Now that we kind of established the context, here's the S&P 500 and tax receipts. And the point here, as the S&P 500 declines, we can see tax receipts decline. S&P 500 declined here in '08, tax receipts fell. Same thing is true for the 2022 bear market under the last administration. There was a bear market in stocks. Sure enough, tax receipts fell. And we will look at data in a second. Actually, I will show that right now. Here is data from, I believe this was from the IRS. No, excuse me, Congressional Budget Office. Might have been the Treasury Department. And so this is a spreadsheet that I was able to download the data. There's some projections here, but what I want to illustrate is 2 points here. So during the top of a bull market, remember .com or going into 2008 or 21, 22, when there was that massive run up in equities, capital gains as a share of GDP surge 5.7, 6% of GDP, 5.8 and leading into '08, 5.8 and then 6.4 in '07. Here in 2021, it was 8.8% of GDP. It was a record in terms of the capital gains tax that was realized by investors, 8.8% of GDP. Percentage of the total tax revenue, we can see during these bull markets, 11%, 10.5, 10.9 during the '07, leading into '08. And then here in 2021, 2022, 15% of total tax revenue was coming just from capital gains. Now, of course, capital gains is not only stocks. This is also stuff like real estate. So it's important to mention that in this video, we'll be looking at stocks specifically. So here is a percentage chart. This is locked. So all 3 of these, it's the percentage change of each one of these going back to the end of the gold standard in the early 70s. We can see the M0 monetary base. This is currency plus bank reserves. Think of the monetary base as kind of base money or official money. This is created by the Treasury and the Mint. This is created by the Fed. And then we have the S&P 500, and then we have total wages and salaries. Well, as we can see, tracking M0 going back, 50 years, the S&P 500 is a good way to hedge currency debasement. This is the base money, right? The M0, but it has tracked roughly in line with the monetary base expansion. Well, look at wages. Wages have only grown at what, 1/5 the rate of the S&P 500, maybe one quarter the rate of the M0 monetary base. Wages, this is total wages and salaries, have grown anemically compared to financial assets as measured by the S&P 500. Here is, again, total wages. This is a locked percent chart. Total wages and salaries in red. S&P 500 as a proxy for financial assets, stock market index, and then the average hourly wage. Here it's even worse. We can see the actual average hourly wage has grown even slower than total wages and salaries. And there's a labor force story there that maybe is a topic for another video. But we can see that the S&P 500 is greatly outpacing both total income, right, of the entire country, every worker in the entire country, and especially outpacing the average hourly wage. Here is a way to look at that. Here is the S&P 500 divided by the total by the average hourly wage. And so what this is showing is the number of hours of work necessary to buy one share of the S&P 500. And what we can see is that it went, historically around about 20 hours of work on that far right scale. You can see about 20 hours of work, when my parents were working, when the boomers were kind of entering the labor force. So there's about 20 hours of work, average work, to buy one share. Well, that number is 200 now. So what this means is that financial assets have just absolutely run away from things like the average hourly wage. Here is a little bit more complicated of a chart, but I promise it'll make sense. So here in white, yellow, and red are three ways of measuring the real economy, the real actual productive economy. The purchasing power of personal income using an M2 denominator, the velocity of money, which is exactly what it sounds like. That's the degree, the speed and rapidity at which money is changing hands in the economy, and then total wages as a share of GDP. And what we can see is that, again, my silent depression kind of framework, this all peaked out in the late 90s, early 2000s. Coincidentally, the labor force participation rate also peaked out here. China was admitted into the World Trade Organization 2001, and ever since, I mean, wages as a share of GDP have been declining since, even before then. But real purchasing power of the personal income and the velocity of the money have both been dropping precipitously for 25 years. Well, if we look, something had to fill that gap, right? You hear about GDP, how great the American economy is. So where's all the GDP coming from? If the real economy is underperforming GDP, right? Personal income is growing. It's just growing slower than GDP, as shown by the yellow line. The velocity of money is falling off a cliff. Well, something has to be growing faster than GDP. So what is it? It's corporate profits divided by GDP. This line is up and to the right. Corporate share of profits have basically doubled as a share of GDP going back to the early 90s. And the S&P 500, again, a proxy for financial assets. The S&P 500 divided by GDP is up and to the right, especially going back kind of post 2008 with all the Fed QE and things that we've talked about in other videos. So here's total wages divided by total wages and salaries, and then the S&P 500. Here is the S&P 500 divided by GDP. So again, this is showing that the S&P 500 is outpacing GDP, because really what we need to be looking at is not just the total number, right? The green line of the total wages and salaries. Really, we need to look at it relative to GDP. So that's what we're looking at here. And as we can see, again, like I mentioned, going back to the 80s, early 90s, that the stock market has ran way faster and has outpaced GDP growth. Well, as we established, it's not only that, it's also corporate profits and, say, share of net worth of the top 1%. There's other things that have outpaced GDP. Government debt, for example. That's why debt to GDP is higher. But here is kind of the disparity between the upper leg of the K-shaped economy and the lower leg. So those that hold financial assets, well, financial assets have filled the void that we just established in the last slide. Total wages as a share of GDP have declined. Um, Going back even further than the 80s or 90s, wages as a share of GDP have been declining, meaning wages are growing. They're growing less quickly than overall GDP. So again, that something has to fill the gap. Well, they found financial assets can fill that gap. And if they just pump financial assets and enact policies that encourage financial assets to rip higher, well, that can fill the fiscal gap that we were looking at here, right? This utterly insane 7% pro cyclical deficit, this negative return on each dollar of debt that we're getting. Um, Arguably the fiscal hole can be filled by corporate profits, right, and the S&P 500 or financial assets. Well, they're kind of interlinked, right? Because the S&P 500, you're owning a share of these corporate profits. So hopefully that makes intuitive sense. That these are kind of the same concept, which is the biggest companies in the country, in the economy. Their profits, not their total overall gross income, their profits are growing faster than GDP, and the S&P 500 therefore is also growing faster than GDP. It is to fill in the fact that for the past 25 years at least, the real economy has been stagnating and in this silent depression. So here is kind of the final way to illustrate this, I think. Here's the S&P divided by tax receipts. I smoothed these. There's a lot of noise with some of these data sources, so I smoothed it. It's a 15 exponential moving average. And then the total wages as a share of tax receipts. What we can see is that wages, again, we established wages are falling way behind the both the inflation rate, right, of the currency, but also of financial assets. We've established that point. But what this is showing is that total wages as a share of tax receipts have been going down. So what this means is wages are growing, tax receipts are growing. We saw the nominal figures for each of those. They're both growing, but tax receipts are total wages are underperforming the tax receipt growth. Put another way, receipts are growing faster than wages. So again, that has to be coming from somewhere. What is outperforming tax receipt growth? Well, it's the S&P 500, especially if you go kind of in this post 2008 era. We can see it here, kind of with the dot-com bubble. And that was the prior high, by the way, that was set in the 60s. We have just, if you go to this '09, the height of the GFC, it is just straight up and to the right. The S&P 500 is growing way faster than tax receipts. So here, I'll link to all. There's a couple articles here. I will link to them. This is IRS data. This is an article at the Tax Foundation, and this was from 2021. And what the point here? Capital gains tax realizations exceeded $2 trillion to reach a 40-year high, driving income growth and taxes paid for high income groups. Now, there's other issues with the tax. One of the articles we'll look at here in a second proposes some solutions to addressing certain issues with the tax system, and I think that is important to talk about. But here, just objectively speaking, I understand people don't feel this is reality, but the top 1% and the top 10% pay the vast majority of taxes just because they are so wealthy. If anything, it's kind of a reflection of how absurd wealth inequality is. That it's not because we tax them at a very, very high rate. It's because they are so wealthy, they generate so much income, and they have so much wealth that even a 20%, 30% tax rate is going to equal a large sum of money. So if you take total $14 trillion and then pay $2 trillion in individual income, the fact that maybe half of this is coming from, call it the top 10%. Well, that's just because the top 10% are doing so much better than the bottom. So here is a summary of the source of particular federal income tax. And again, here you can see the top tax rate for each of these. And we looked at the capital gains tax as a share of revenue. But here, again, kind of illustrates that point that I was making. The top 1% pay a relatively low tax rate. But yet, if you look at the share of the total income and a share of the total taxes, the top 1% alone basically pay half of all income tax. So here is another article from the Tax Foundation. And again, this is for 2021. The point here was basically tax revenue was surging and it hit a record high. And the reason for this is that investment income was surging. The capital gains was, this is net capital gains, taxable interest, ordinary dividends, right? If you hold stocks that pay out a dividend, accounted for nearly $2.6 trillion of income in 2021, more than businesses' income and retirement income after near record high cap gains realizations in 2021. This was for the sources of tax revenue for 2021. So it goes through. Here is the sources of each component and the amount in billions. So wages and salaries are paying about $9 trillion in 2021. A sale of capital assets, again, this is that cap gains, like stock market, for example, $2 trillion, like we had just read before. And of course, there's other components here, businesses, net income, net loss, $412 billion. Ordinary dividends are actually up there, right? Like when you own stocks, generally you're getting dividends. So it's not only the capital appreciation, right? The stock going up and then you sell. It's not really only that. We should also try to include the dividend and interest that is coming from financial assets. Unfortunately, they don't break it down that way. I would consider it all kind of one thing. Wages and salaries comprise the largest overall source of income for the government and income kind of total. But again, remember, we established with the prior charts, income is growing way, way, way slower than both total wages and salaries, and especially the average hourly wage, are growing much, much slower than the debt, than monetary debasement, and GDP, right? We established average wages and salaries divided by GDP, which shows that exact thing, are down and to the right. So again, there has to be something to fill that gap. Well, here's what it is. Investment income makes up nearly 2.6 trillion of personal income. This is one of the reasons that I think personal income is somewhat of a flawed measure for certain things, is because it includes interest, dividends, things that really only apply to the top 1%. So here's a bar chart that shows investment income 2.5 trillion versus wages and salaries, which is about $9 trillion. You can see taxable interest is a very small component, as well as dividends. The vast majority is coming from that capital gain, right? The stock goes up and you sell it. Now, this is really important. So this shows the composition of income varies greatly with the income level itself. So if you are worth $1 million or more, or excuse me, your total income is $1 million or more, look at how much of your overall $1 million or more, look at how much of it comes from investment income, right? This is dividends, cap gains, that sort of thing. Look at for like the average person who's making between, say $20,000 and $100,000 nowadays. Look at the tiny, tiny, tiny sliver. It's 3%. If you make 50K a year, only 3% is coming from investment income for in terms of your actual total income and therefore taxes. For anyone making under 100, from 50 to 100, it's 3%. So look at that compared to 51%. The wealthy are wealthy because of financial assets, because of capital gains, and we established the top 1%, top 10% pay the vast majority of the total sum of money. And so the government has an incentive here to run the economy hot and generate more capital gains. Now, it's also important. This is from the Peterson Institute. I will also link to this as well. This shows the income rate, the tax rate on income, and the tax rate on capital gains. And as we can see, this is something I always say in the comments to people talking about taxes. The fact that capital gains tax rate is so much lower than ordinary income is one of the first things that I think would be that if I was elected president, elected leader, this is one of the first things to change, in my opinion. There's no reason why, if you work for a living, you should be taxed at nearly a double the tax rate of someone who just hoards capital. So here, high income individuals receive a greater portion of their income from capital gains, and therefore they benefit disproportionately from that preferred rate, that lower rate. We established in the prior article that the vast majority of the wealthy, the very wealthy, the vast majority of their income and wealth is coming from capital gains. Preferential treatment of capital gains reduces federal tax collections by about $345 billion per year. So it's a huge tax break. We're talking, about 5 trillion in tax receipts. If we were to able to increase that by $350 billion per year, just by changing these three things, it would be a massive windfall for the government. But of course, they don't want to upset their donors. And so therefore, they don't do that. Because of course the donors are wealthy, they're in that top 1%. They have a bunch of financial assets. They love the lower cap gains tax rate, and they have a bunch of financial assets. So there's two different kinds of cap gains. There's short-term cap gains, which is basically treated as income, no different than if you work for a living, and then long-term cap gains. When we're talking about cap gains, we're talking about these long-term cap gains. That is what is preferred from a tax perspective. If you say buy a stock and sell it for a gain in a week, you're going to pay your normal income tax rate. But if you hold it for more than a year, you get this much lower rate. Who pays the capital gains tax? Here, again, is another way of illustrating that it is really only the high income people that are unlocking and not exploiting, but benefiting from the appreciation of financial assets. Here we can see that it is just no contest between kind of the average person and those that are worth $10 million and over. You can see that even before we were looking at $1 million and over, and you can see the disparity even between $1 million and more than $10 million, like the exceedingly wealthy people. It is night and day difference. Here is the chart that I think is really critical. I put this in my so originally the thesis behind this video I did as an article way back. It feels like why pullback in the S&P 500 will not be allowed. This was published on my X account, and of course goes through a lot of the same concepts that we're talking about here. This was published back in 2024, in August of 2024. You can go find that on my account. But the thesis was basically that as the fiscal situation gets worse, we know that wages and total salaries are underperforming. We know the real economy is stagnating more and more and more. There needs to be something that comes in to outpace and keep pace with monetary debasement and the debt growth. Well, the only thing that is really outpacing GDP are corporate profits and the S&P 500. As soon as those start falling in line with GDP, they can still grow, but if they're growing in line with GDP, the whole thing kind of falls apart. Well, here we can see the receipts from the capital gains tax have been volatile, of course, as the stock market is volatile. But look at as a share of GDP. We were looking at a table before in the Excel spreadsheet. This was a record, and when I wrote that article, it had just hit that record, which it talks about here. So as the stock market declines, as we become more financialized, this effect, the decline in the cap gains tax, and therefore the effect on the deficit, becomes more and more important. And so we know that the top 1% own the vast majority of financial assets. We know that the top 10% own 93%. Top 1% own half of U.S. equities, half of U.S. stocks. Top 10% own 93% of U.S. equities. So we know that the vast majority of financial asset ownership is done by the very, very, very wealthy. We know that corporate profits in the S&P 500 are the only thing really outpacing GDP growth. And so as the tax burden, as a deficit and fiscal issues become more acute, basically the government is incentivized to enact policies. I'm not saying that they are doing anything nefarious with, say, the plunge protection team, which, by the way, is accountable only to the president. You can look that up, but I'm not saying that. I'm just saying that the policies that both parties enact they are incentivized to benefit things like financial assets. We did a video on housing and looked at the same concept, and the same is true there with, like, say, zoning laws. And if we were to just change a couple different things, we're talking like $500 billion in unlocked revenue. If we're running a 2%, a $2 trillion deficit, $500 billion, you just cut the deficit by a quarter. That's a good start, right? It's not the end of things, but it's a great start. And here they go through some of the step up in basis at death and increasing the capital gains tax revenue rate, which again I think is just blatantly straightforward. How is it that if you work for a living, you are taxed lower than if you just hoard financial assets? It makes really no sense because remember, financial assets, the main reason they are going up is they are more dollars are being printed. As more dollars are being printed, the price of, say, gold or housing or the S&P 500, the price will go up. Here, in fact, this chart illustrates that beautifully. The monetary base has grown exactly, basically, at the same rate as the S&P 500, going back to the end of the gold standard. We know that wages are not growing. We know that whether it's the average hourly wage or total wages, as we're looking at here, that source of income is not growing fast enough to continue to plug the hole that is ever bigger. Year after year after year, that deficit is getting bigger and bigger and bigger. As we can see, just in the past 25 years, we went from a 2% surplus, budget surplus, to a 7% deficit. That is a massive swing in just 25 years. So as the deficit gets worse and worse, the government is incentivized to pump the only thing that is outpacing GDP and the debt, which is financial assets. And so as those financial assets go up, there are more cap gains tax that lessens the fiscal impact, right? That increase to the deficit is lower. And we know that the wealthiest individuals in the country own the vast majority of the financial assets. So you plug all three of those together, and basically the government's incentivized to never really let the stock market decline in a material way. Now, sometimes a small decline like this can stimulate people that bought in back here and rode the gains for a year or two, trigger them to sell. And so that is true. And I'm not talking about a small 10-15% bear market, but anything much more than that, and it starts to decrease revenue to such a degree that it blows out the deficit. Bond supply must come in and must increase to fill that fiscal hole. Well, as bond supply goes up, yields go up, assuming constant demand, right? On, and you can very quickly get into a fiscal spiral like we looked at with the UK yesterday. So, anyways, unfortunately, the incentives are all there for the government to never really let. You might hear on, things are going to crash. It's the next Great Depression, 70-80% decline. If that happened, the fiscal deficit as a share of GDP would go like 20% of GDP. You're full blown printing the difference, emerging market banana republic levels at that point. And so it just cannot be allowed. Now that's not to say that there shouldn't be meaningful reforms to some of these structures. And in this last article, it does talk about some, a good start to some of these indexing capital gains to inflation for one. So it does talk about there are some easy things that we could do politically to sort this out and equalize things a little bit without having to go back to, say, an 80% top marginal tax bracket or anything like that. We see the effect that is having on the UK. They just keep raising taxes. Well, that keeps slowing growth. And by the way, all the rich people just flee. They just take their money and leave, go to a different country. So they're kind of in this spiral that is, the government keeps trying to solve by higher tax rates. and that just decreases growth, which therefore decreases the tax base, and you get into a spiral, and then all the capital just flees anyways, and so it's untaxable. So these are some good starts, in my opinion. I will link to all of these different articles that we've looked at, and you can go read them through them yourself. But yeah, hopefully that was helpful. I see a lot of kind of bear posting. We're in for the next Great Depression, 70, 80, 90% decline. It's a bubble. It just can't be allowed. And the government has tools, by the way, not only through policy, but something called the plunge protection team, which, by the way, is not the technical term, it's a colloquial term. But you can find information on that, through Google or ChatGPT. So, anyways, hopefully that was helpful, and I will catch you in the next.